If you are a trend follower like me, chances are you have used a trailing stop loss at some point in time. Here are 5 easy trailing stops you should add to your trading arsenal.
A trailing stop is a dynamic stop loss that moves in tandem with prices to protect your floating profits. It is pegged to the most favorable price obtained thus far. For example, if you're in a short trade, the trailing stop moves downward as profits accrue. If prices move against you, the stop does not move. In this way, the trailing stop protects your downside, without limiting your profit potential, unlike time stops and profit targets. Due to these benefits, I'm a big fan of using trailing stops in my trend-following strategies. A pip-based trailing stop is probably the simplest you can implement, though it can be very effective. It is similar to dollar-based stops, except that it is insensitive to currency value. Here are 5 additional trailing stops that are both effective and easy to program. The average true range, or ATR, is one of Wilder's famous creations and is probably the most popular volatility measure among retail traders. A bar's true range is the largest of the following price differences: its current high and low, its current high and previous close, and its current low and previous close. In most cases, true range will simply be equal to the bar range. However, if large price gaps are present, true range will exceed the bar range. A 14-period simple moving average is then applied to the true range to produce the ATR. Volatility-based stops offer the following benefits. Since they automatically adapt to market volatility, you can use the same trailing stop across different time frames or markets. In addition, if you calculate your position sizing using the size of your stop, a volatility-based stop will automatically normalize risk. You will trade smaller sizes in volatile markets and larger sizes in quiet markets. So if you trade a single strategy across a number of volatile markets, an ATR-based trailing stop is a good option. For starters, you can place your stop 3 times the ATR away from your entry price. Another volatility-based option is the standard deviation stop. Standard deviation measures the degree of dispersion from the average price, as per the formula. Closing prices are usually used. Don't worry if you'd rather not calculate that, MT4 provides the standard deviation indicator. The 14-period standard deviation is shown together with the ATR, applied to the same price series above. Both indicators show the same trends, but the standard deviation seems more volatile. Why this difference? Standard deviation accounts for directional volatility, while ATR does not. Consider the 2 hypothetical price series below. Each of them consists of 4 bars of identical high-low range. The first is from a flat market, while the second is from a steadily trending market. If you use the ATR, both markets will give the same value. But if you use standard deviation, the trending market will give a higher value than the flat market. If you look at the standard deviation formula, this is because the increasing prices are further away from the mean. If you find a market that is steadily trending, like the one here, the differences between standard deviation and ATR will become more apparent. The standard deviation captures directional volatility much better than the ATR, and this causes its value to increase much more. Every trend trader has tested moving averages at some point. 2 popular trend-following indicators, the Bollinger Bands and Keltner Channels, come with inbuilt middle moving averages that can serve as trailing stops. The Bollinger Bands use a simple moving average, while the Keltner Channels use an exponential moving average. Here's an example of a trend trade using the 50-period Bollinger Bands. We go long when price penetrates the upper Bollinger Band, and exit when price penetrates the middle moving average. Suppose you've decided to give moving average trailing stops a try. I know what you're thinking, which moving average should I use? Simple, exponential, linear weighted? The chart below shows an overlay of the 50-period simple, exponential and linear weighted moving averages. There really isn't much difference between them, except that the exponential and linear weighted ones place more emphasis on recent prices. I have tested simple and exponential moving averages the most, and believe they do the job well enough. If you're looking for a more exotic moving average that adapts to market noise, you can check out the Kaufman Adaptive Moving Average, or KAMA. The KAMA reacts quickly in trending markets, and slowly in flat noisy markets. Ultimately, I think the choice of moving average does not matter that much. As long as you give your trades enough breathing space by using a mid to long-term moving average, you should be good to go. Try to use the simplest solution whenever possible. Donchian channels are created by plotting the highest high and lowest low over the look-back period. Here we have a 50-period Donchian channel. Like the Bollinger Bands, the channel width is an indication of market volatility. The middle line is computed as the midpoint of the upper and lower lines, and is a popular trailing stop among trend traders. Lower penetration of the channel implies strong downside momentum, and is an opportunity to enter short. When price is close above the midpoint, reversion to the mean has occurred, and the trade is exited. Don't let the Donchian channel's simplicity fool you. It was the basis of the famous turtles experiment in the 1980s, and we all know how well that turned out. If you find the Donchian midpoint stop too tight, you can add a pip or ATR-based buffer. The parabolic SAR, or stop and reverse, is another Wilder creation that is often overshadowed by the ATR and RSI. The parabolic SAR is used to determine trend direction and price reversals, and appears as a series of dots, either above or below the price. The parabolic SAR was built on the concept that time in the market should be minimized. Here's how it's calculated. EP is the extreme price obtained thus far, which is the highest high in an uptrend, or lowest low in a downtrend. AF is the acceleration factor. It is initially set to 0.02, and increases by 0.02 each time a new extreme price is reached, up to a maximum of 0.20. Don't worry about the calculation. Here are the key points. When the parabolic SAR is below the price, the market is in an uptrend. Conversely, when it is above the price, the market is in a downtrend. The parabolic SAR keeps advancing towards prices, even when the market does not reach a new high or low. If the calculated parabolic SAR value falls within the current period's bar range, it flips to the opposite side of prices, signaling a change in trend direction. When used as a trailing stop, you should exit your trades when this flip occurs. Here's an example of a long trade that was entered when the 50-period CCI crosses 100, and exited when the parabolic SAR flips to reflect the downtrend. The parabolic SAR generally works great when you have smooth trends with minimal pullbacks. For most cases, I find that it tends to be too volatile. It takes only a small pullback for the indicator to flip. I recommend that you reduce the acceleration factor's step or maximum value. When you load it in MT4, you can change the default values as shown here. With short-term strategies, you generally want a larger acceleration factor. But for longer-term trend-following strategies, you want a smaller acceleration factor to give your trades more breathing space. So if you're big on trend following, trailing stops certainly deserve your attention. Keep them simple, which really helps with programming. Keep them loose enough so you can ride the occasional long trend. And most importantly, be sure to backtest before going live. Thanks for watching, and don't forget to subscribe.